Hi, everyone, and welcome back to another show. My name is Tyler, and I'm here with Matt, the founder of ORATS, an options analytics platform built on top of over 15 years of proprietary options data. Our dashboard is integrated with Tradier, meaning you can research and discover trades on our platform and then seamlessly send them through to your Tradier brokerage account. Today on the show, we're going to look at zero DTE's effect on the market as seen through Skew. Matt, do you want to share your screen and go over our trades from last week?
Sure. Thanks, Tyler. So we had two new trades. We had a Baidu. It's down a little bit. We still got some time left on that one. And then we also did a Ulta, and it hit our alert. So I went in and traded out of it. So we bought it for $385 or $3.85, and we sold it for $4.85. So that was a nice trade. And then we still have some existing ones. SMH, we're up a little bit. SPY, I don't think we had one. I think that's from something else. But our single options are doing well. TRP is up 180, and WES is up. Let's just see. Yeah, we bought it for 15. It's 42 cents, and TRP also bought it for 15, and it's at 45. So doing well on those small guys, Tyler.
All right, that's great to hear.
Yeah. So what are we talking about this week?
This week, we're going to look at zero DTE trades specifically. Matt, you have a lot of experience. You've been around for a long time in the markets, and you've made some notable comments on zero DTE. Can you just go over what those are and sort of your view on it, and then we can go over some of the indicators and ORATs?
Yeah, it's probably the biggest thing to be introduced to the option market this decade. Volumes are way up. There's a lot of consternation in people saying that it's going to be the end of the world. I've always held that it's actually a good thing. And I'll try to get into some of the reasons. And I was also recently interviewed for Risk magazine, and it's a subscription one, but I got in over the fold here. And so kind of the argument that I make is that before zero DTEs, and actually including up until now, market makers have a systematic position on that is short out of the money puts and long out of the money calls. And the reason that they have this position is because many banks are regulated to have a certain amount of risk slides on their books. So meaning if the market goes down a certain amount, they have to have protection on. So a lot of banks will buy out of the money puts in large size, and just people that are long stock, they'll buy out of the money puts to protect themselves. And so the market makers have to take the opposite side, and they have a large positions of short puts. Caller. So a caller is when, if I would buy a put and sell a call against my long stock. Well, the market makers are taking the opposite side. So what they ended up with were a lot of long calls and a lot of short puts. And what happened is market makers are active hedgers, meaning if the market changes and the positions that they have on change their outlook, meaning if they have a lot of short puts and the markets are going down towards those short puts, the nature of options means that they're going to start getting a lot shorter and a lot shorter, because those out of the money puts are now becoming near the money, and more important, it's getting more short deltas is the way that option people talk about it. And so when market makers get that position on, they will sell the underlying. So what happens, especially in periods of multiple standard deviation moves to the downside, the market makers have to kind of panic sell as the market's going down. It's very difficult to sell, and they just exacerbate the problem. So that was what was happening before. And then conversely, again, when the market starts going up, their calls that they're long start going up in price, or up in delta at least. Often the price goes down a little bit because volatility comes down, but so it goes up towards that point, and they're selling against the market going up and buying when the market they're selling when the market goes up, and then when the market goes down, they have to sell to keep their positions stable. So what zero DTE has done, and I should also mention, there's some added evidence for this, but maybe I'll just explain zero DTEs first, and then we'll go over the evidence. So with zero DTEs, all of a sudden there started to be a lot of trading in the, let's just say, a week and less to expiration. And especially when the everyday expirations were launched in May of 2022. People were able to then trade every day, and they kind of built businesses around it. And the trading, there's been studies out there, but the trading is two-sided, meaning they're, unlike what was happening systematically to the market makers previously, especially in S&P related underliers like SPX and SPY. Whereas before, people were buying only puts and only selling calls. Now there's a lot more variability in the trading, and often it's two-sided, and often it's spread related. So now, with all this liquidity, market makers can hedge that risk that they used to have to not only be able to sell the underlying if it moved. That's no way to manage risk, really. And so they had to not trade as much even. So now what we're seeing is now the market makers are able to trade more. So there's more liquidity and there's more option volume. And there's less volatility to the downside because now they can own the shorter dated puts. And to the upside, there's less pressure, and it's, I think, helped the market go up. So as opposed to what some people were saying, where the zero DTEs are going to cause a lot of problems, I think they've actually helped and actually fixed some systematic problems that were in the market so far. Does that make sense, Tyler?
Yeah, that's interesting how your spin on it is that it's sort of fixed the market, and that's kind of contrary to a lot of views online, a lot of kind of doomsday scenarios where people are saying it's gonna crash the market, or it's gonna spike this and that. So it's a bit of a contrarian view, but it definitely makes sense the way you put it.
Yeah, and I have the power of seeing what's happened since then, and it's been more on my side what was predicted. So let me point out some actual facts behind what I'm saying. So here's the line, about May 22, and this is the slope. The ORATS slope is on the bottom, and the typical thing that people use to look at skew, the implied volatility of the 75 delta versus the 25 delta. I would argue that ORATS is a little bit more consistent, but that's neither here nor there right now. But the point is that previous to May, the average slope, that wasn't a very good line. Let's try a good line.
Matt, can we talk a little bit about just what slope means in relation to the skew, and the skew being different with zero DTE options, just sort of bridging the gap between those definitions?
I didn't understand what you said about skew being different for zero DTE options.
Oh, just how slope is the we take a measurement of the skew, which is the implied volatility from 0 to 100 delta. I was just going to sort of define what the slope indicator is. So
okay, yeah. So I can
all of what you're saying compressed to one indicator. What does that mean?
Yeah. So here's typical implied volatility. These are the low strikes, and that they're generally higher than the high strikes. So then we draw a line through there, and at the tangent of the 50 delta, or right at the middle, that's every 10 deltas, that's the slope. So if this was 100 vol, this would be 105 vol if it was a 5% slope. And then since 0 DTEs, then it's a lot flatter, like the puts are closer to the calls. So that's what slope is. That's how our slope is. Whereas the 75-25 just measures a 75 delta divided by a 25 delta. It doesn't get as much information in it, and I don't think it's as consistent. Is that what you were asking, Tyler?
Yeah, I got it. So we're going from a chart of volatility on the y-axis, implied volatility on the y-axis, and then strike deltas on the bottom axis. And
Right.
just for clarification, those strike deltas for call and puts, or how does that work?
Yeah, it's just the low strike versus the high strike is a way to think about it. It is by delta, so it's just the high call delta over here and the low call delta over here.
Got it. Okay.
So that's slope. And so basically what has happened is the average slope, is around 7.5, and that's kind of this red line right here for the many years. This goes back to 2007. And this is the line separating when the 0 DTEs came in. Okay, that's a good DTE. So this is when that happened. And what you could tell is almost to the month, the slope immediately went down. That's this right here, to where it usually wasn't. And it got as low as it ever had been. And the average now about 4, almost half is the slope. So that's very telling. And if someone denied that has to do with 0 DT, I'd wonder, because that was what I would predict, is that, because there wasn't that systematic position on anymore, whereas market makers were able to hedge out a lot of it with the 0 DTEs, they could bring down the prices of the puts, and they don't have to have them way up there and discourage any trading in that. So, and we've seen a lot more volume. Actually, yeah. So here's the volume in options. I mean, you can see how much, that's way up. That's way up here, and whereas before, maybe it was down here. So again, a lot more options trading, a lot shallower skew, and the market's been up quite a bit since then. So I think all of those things have some source in the 0 DTE.
Yeah, so basically it boils down to those low strike options, the implied volatility going down. And that's sort of what's dragging down the skew or the
Right.
slope.
Right. Okay. But also the calls are coming up, because before they used to sell only be long calls, and so they were getting pounded. So they would just lower the price, buy more, lower the price, buy more, lower the price. Now they could sell some calls. So the calls have gone up relative to the puts.
And that's sort of what you're, related to what you were saying before about spreads and other, multi-legged strategies becoming more popular among retail traders, so that it's not just long calls being bought anymore. It's different ones.
Exactly. There's just so much more trading, and the trade isn't one way. It's not just selling calls, it's both ways. So now, they could vary the prices as they should be able to in a market making situation. I guess finally, the slope versus the single stocks used to, that ratio used to be a lot higher. Now it's normalized as well.
So the big question, and I'm sure everyone's wondering, how can we use ORATS? How can we take advantage of what we know here, of what we're seeing with the slope, and how can we trade based off of this information? How can we beat the market?
Well, I think a few ways. One is there's a new normal. You don't call slope low anymore just because it's down here, because it's now you got to kind of look at slope low relative to what. So even though we might call this high, it used to be not that high, but now it would have been high. Does that make sense? So it's a new normal in slope. So if you're doing a slope trade, where you tend to trade the out of the monies against each other, you should consider that slope now in the new normal, like with 4 as kind of the median, and between 2 and 6 is kind of where it's been. Yeah, so that's one thing. And then another thing is this volatility has been just lower overall. And the market volatility is kind of out of the market. Obviously anything could happen, but I think new normals is going to be, heading more towards, lower volatility, barring extreme macro conditions. But that's what I would say. So, from our standpoint, I guess we could look and see, what type of trades are coming up in trade ideas that might take advantage of maybe lower volatility coming up, lower skew coming up, and yeah, I mean, are there any trades that we might like that would benefit from that? That would be one thing, and another thing is just again to look at the put call skew differently. Like it's a new normal, so just because we think it's low doesn't mean that it's low relative to where it's going to be, coming up.
Could you zoom into your screen a little bit, Matt, to see the trade ideas better? You have a bit of a wide view. One thing I wanted to point out with the trade ideas and with our backtester in general, we use the slope percentile as an entry trigger. So that's another thing to keep in mind when we're looking at this, Matt. We have a slope percentile indicator that looks at the current slope relative to the last year. And, sort of on a percentile basis, where does that stand? So, that's another thing we could utilize when we're, thinking about doing a trade.
Well, yeah, I think that's a good point. And right now, you could always go in order to see where it is, you go to the backtester and you can go to the entry triggers, click on that and see that, the current moderate situation is between, so it's, you would expect that maybe to be low, but we've been in this situation now for 2 years. So we've been living with a lower slope for 2 years. So right now the market has kind of accounted for all of that.
Yeah, that's interesting.
Yeah. And then you could always, just pick, what type of trade does well in a moderate slope percentile. Because, some people still may consider what the slope environment that we're in right now low. But, if you look at it in terms of kind of the new normal, it's, we're calling it a moderate situation. So now what I've done is I'm only looking at trades that have, iron condors that have the slope percentage as moderate, and what type of positions have done well with this outlook. And the IV percentile is also moderate. So yeah, we would take anything that's in the position. So this doesn't look too bad, Tyler. It's a pretty quick trigger, right? So it's 25% stop, 25% profit. So let's do what we normally do. Let's look at this in terms of other back tests as well. So what might we vary? We could open up this could be maybe something from 20 to 40. And then this could be something from 5 to 20. So we should get a couple more at least. Oops.
Yeah.
To 20. And then, we should probably, it's only picking these. That's why there aren't that many. So we'll go to select all here.
I mean, we want to find one that is working in the current environment. I mean, we can go back to the trade ideas. Since the
That's
trade
true.
ideas only look at the ones in the current environment with the slope.
That's true, but I wanted one that was working in the current slope environment, since that's what we're talking about. And I also want to then check out other similar types of strategies and see how it's done. Especially, I like to sort descendingly and see if we could find out the bad ones and why they're bad. So, for example, this is a bad one. It's a similar outlook or similar expiration DTE, but VIX is moderate, which is a higher VIX, and then this is below, so the 50-day. So that's clearly not. I'm not worried about that right now. Here's one where the slope is moderate, IB percentile is high, so that's clearly not today. So here's one where RSI is moderate, VIX is moderate. So I think VIX is low now, right? Yeah, VIX is low, and RSI is moderate. So, so that's I would call that a little concerning, because that's a similar exit triggers. Or I guess that's what we have on as exit triggers. So if we were to look at different exit triggers, we could do that in a moment. So, but mostly, if we look at these bad ones, there aren't that many. Here's where it starts to get positive. So there are just a few, really kind of ones that went against you. Slope is above, again, IB is high. That doesn't happen that much. As a matter of fact, I'm surprised that the time in the market is that high for that particular one. But I guess this is kind of a long-term hold. Stock price is below. I mean, this is the only one I'm a little bit concerned about. VIX is moderate, slope percentile is high, but we're in a moderate situation right now. So I'm actually pretty happy with this particular. I don't think that the counter argument is that good for when the strategy does bad. So I like it so far. Tyler, I don't know how you feel about this.
Yeah, that sounds good.
All right. So again, with the back test, the cool thing that we can do is then scan for options, and then we could also it's not finding it because of the spread price, Tyler.
Oh, interesting.
Yeah, I noticed that. So what this is saying is you have to get a lot of money for this, and you're not getting that much because volatility isn't that high. So back to the drawing board.
Yeah, I mean, that's the challenge of doing something outside of the current environment.
Well, it's in the current environment. It's just it has a spread to stock ratio that's low, that we're not really in right now. So I'm gonna take that off.
I wonder if that trade was even in the market that often. We could have checked out the percent of time in market.
Well, it has to be over 40. So again, I'm gonna then check out slow percentile moderate, because that's a trade that we want to do. But I just took off the spread to stock. So there's a spread to stock, and actually we could check that out right now, Tyler. It was only 46%.
Yeah, that makes sense. I feel like.
All right, but here's one that doesn't have it, and the results are decent.
Yeah, I mean, it's almost a whole percent less annual return, which is a little alarming. But
yeah, that is true. So should we pass and try to find another one, or what?
Yeah, I don't know how I feel about this one.
Okay,
I think that spread yield, might have been a big factor in the success of that trade.
Yeah, no question. I mean, what they're saying is you want to get a lot of money for it.
Right. Yeah. If we can't get it, then.
Yeah. So again, here are they coming up. I mean, this one's only about 30 basis points off.
Yeah, it's not too bad.
Let's take a look at some of the performance So the sharp isn't very good. Drawdowns aren't too bad. Margin return isn't that great. I'd try this one out, Todd.
Okay, we can try it out.
Again, it's was it 50% loss or and 25% profit, I think.
I think yeah, I'm not sure. I don't remember.
Yeah, let's go back and make sure. So yeah, it's a 50% profit target. So it's I had it backwards. 25% stop loss.
We can just port those exit triggers over to make sure we're doing it the right way.
Right. So we'll scan for options. So this is the top iron condor. I like to adjust these a little bit. So that looks fine. The S percentage doesn't really matter here. So let's just take a look. Delta's not too bad, a little bit downside, but not too much. All right, so let's do that. Let's add, well, actually, let's add those after. So 10.25, so we'll give them a few cents here. Oops, I should have forced it. Oh, it filled anyway. All right, so now that we have it filled, we could go to our positions and SPY now, the iron condor, and let's add in our alerts. So now we want to be alert. If I had done this before, I could just add them in again, but here's going to be a profit and loss above 50% and below -25. And then we'll say paper, T-Hub, 722. All right, I think that's a good one, Tyler.
All right.
And I'll actually take a picture of it just to remember things. So if I get that alert off camera, we'll close that out. And you can see the alerts right there for you, and then also the fact that it's checking for exits now for that particular position.
Excellent.
All right, Tyler. So zero DTEs we talked about at length today.
Yeah,
I think I got across well what I think is the ramifications of those, and it's important for every trader to try to understand this, because it has changed the option environment greatly. And the way it changed it, as we talked about, was to effectively lower the skew. That was the first giveaway. But then it helped liquidity and trading, because the market makers now have a more balanced skew and could trade more at more beneficial prices to traders. So traders should try to get better prices. And the zero DTEs also have that effect on making the puts cheaper. So hedging is less expensive than it was before. And then there's an ability to sell calls and get more for it. A lot of people stopped selling calls because they just weren't able to get that much, because market makers brought down the prices so much. So there's a lot of ramifications out there for the normal trader. That's why we focus so much on this. And I think it was a good show, Tyler, to talk about that.
Yeah, I mean, that's a lot of great information, and it could only come from you. I mean, you've been in the market for so long, and you have a lot of good thoughts on Skew and zero DTE, and I'm sure we'll be hearing more about these indicators and stuff as we keep doing these shows. So appreciate.
Yeah, the reason that you're getting this is because I've lost probably more money on the Skew going against me, or I've lost more money on not watching these things. So they've been expensive lessons, and hopefully we could save money for some of the people out there.
Well, thank you for sharing your insights, Matt. I mean, it is earnings season also, just so for next week, we'll most likely be doing a show on scanning for earnings trades, so stay tuned for that. But until then, if you have any questions, you can post on our community tab. You'll find lots of videos and a lot more of Matt's thoughts on the community tab as well. That'll be in our dashboard. And any other questions, you can reach out to us at support@orats.com. Thank you, Trader, and thank you, Matt, again. And we'll see you guys again next week.
Thanks, Tyler.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.